The market's up, Chuck, and with oil prices back over $70 a barrel and maybe kind of normally priced, and the recession, being officially deemed to be over by the Fed chairman, it might be a time to take a look at energy in your portfolio for those of you who like investing in those things. Now, as I'm saying abroad, personally, I've never been much of a fan, but let's just look at why. There's a lot of cyclicality contrary to what people believe about energy, even though it's such a dominant and important part of our everyday lives. So what I've got here are the plotting of the earnings of Exxon. If you can see, Exxon really had some kind of flat growth from the period that ended through 2002. Earnings didn't do much. Then, of course, the recession came in 2001, and then that led to a several-year span where you had a very accelerated growth in earnings, and you saw the stock price follow that. And then, of course, when the recession came, oil prices collapsed into the $30, $35 barrel range, and the prices of oil stocks fell, but not necessarily precipitously relative to their earnings growth. However, if you assume that there is going to be a long sustained recovery, and that possibly the drop in petroleum consumption this year might only last this year, and oil will reassert itself, and the price will begin to rise again in the future, then certainly now would be an attractive time to be looking at oil stocks. So if you look at Exxon over the last 15-year period, basically, you can see that, it's had pretty good growth. Even with this big drop in earnings, it's averaged about 10% growth. When you look at it from a track record standpoint, that equates very clearly, or closely to its earnings growth rate. And of course, it's done a lot better than the S&P just on a compounded annual rate of return of 9.5% versus 3.8. But I also want to point out it's, generated a very generous dividend at the same time. The next example is ConocoPhillips. It also has a relatively high average growth rate. It, very similar to Exxon, had a period where during the last recession of 2001, the price dropped, or the earnings dropped rather. Then we had this big surge in earnings, and a collapse in earnings, and a collapse in stock price. But trading at around 8.5 times earnings with a 4.1% dividend yield, and certainly a very high quality company, a 68, almost $69 billion behemoth, that has also produced a pretty good track record compared to the market, and certainly thrown off a very rich dividend yield, might be another example to consider. But I do want to point out the cyclicality of this, kind of company, regardless of the fact that it has generated a long-term return. There's certainly been a lot of speed bumps, along the way. And another example I'd like to show would be Occidental Petroleum, very similar to Exxon that I showed in the beginning, but once again, you see a very consistent pattern here of flattening of earnings during the recession, rising earnings, real good stock values, then of course collapse. Now, I also want you to notice we've also had a pretty strong recovery. In the case of Occidental, you're already trading at 16 times earnings, much higher than you had with ConocoPhillips a moment ago. But again, another company that's generated a very strong track record with a very good dividend yield over time. And again, if you were going to be looking at companies like this could possibly be a very attractive time to buy them. Although again, once again, they're still not an industry that I'm particularly fond of. But for those of you who believe that the long-term growth of energy is, or the use of energy is with us, these may be good examples. My last example is Chevron. Once again, I want you to see a very similar pattern: drop in earnings during the last recession, rising earnings, and then of course we had the collapse during the recession, which brought stock values down. We have an 11%, 11 times. You can buy Chevron today 11 times earnings, get a 3.7% dividend yield. It's had a very attractive rate of return, just like the other examples I showed you, compared to the S&P, and has generated some nice dividend income. So if there ever was a time to buy it, it might be now. But again, I encourage you to do your own homework. I just wanted to let you see what this sector really looks like, and what these companies look like. I like companies with a little more consistency than this, and a little more predictability over time. But for some of you who believe in long-term energy, these are some obviously choices today that you may want to consider. It's Chuck Harvell saying thanks for listening. Talk to you again tomorrow.